Good morning and welcome to CanadianAgMarkets.com. My name is Brian Como. Today is the 10th of September. It is the morning. Normally, we put out a video in the afternoon after the ag markets are closed. Today is a little bit of a special occasion. What I have here is a video of a friend of mine named Karl Schamotta. He works for the firm Corpay Solutions. They provide foreign exchange solutions to businesses. He had the opportunity to talk with the Financial Post recently. So I thought I would go through that video and kind of comment on it in real time as we go through, just to talk a little bit about the Canadian dollar and how that might affect Canadian agriculture and Canadian producers here in the Western Prairies. So let's get into the video, and I'll pause every once in a while to put in my comments about the how it might affect the ag industry.
Hi, Karl. Let's talk about what's happening in currency markets. This ahead of monetary policy announcements from both the Bank of Canada and the Federal Reserve in their September meetings. Both the loonie and the greenback coming under pressure recently. What are you seeing?
Yeah, it's kind of funny. The Canadian dollar is up about 4% against the US dollar this year, but it is at the bottom of the leaderboard when we look at major currency performance. Basically, the dollar is the underperformer on global currency markets this year. And yeah, so the big driver in the last month and a half or so is a shift in monetary policy expectations in the US and Canada. So here in Canada, the weak employment numbers that we're looking at, the still relatively stable inflation numbers, those have cleared the way for more cuts from the Bank of Canada and have depressed interest rate yields. And at the same time, in the US, we have seen a watershed move in expectations ahead of the Fed meeting in September, as well as across the curve on the basis that the US employment market is clearly slowing.
I just wanted to add a little bit of commentary here, um, uh, just to kind of add to their sentiment. I think they've been talking about the last few weeks as far as the watershed moment and things like that. But the US dollar has been under pressure for quite some time, particularly after President Trump took office and started implementing tariffs. Now, markets generally hate uncertainty. And so that has created a lot more volatility in these markets. And the US dollar has become out of favor as a reserve currency or as a reserve asset. And we are seeing that true in other assets such as gold and some other commodities. So I just thought I would make a quick comment on that.
Maybe let's just expand on that a little bit. What is the expectation then? I know you had mentioned yields a little bit. Maybe give us a kind of a base case scenario. What happens when the Bank of Canada, I guess the expectation is a few rate cuts by the end of this year. And I think investors are also betting on three rate cuts from the Federal Reserve. What is the expectation then to equity futures, yields, and maybe tell us what happens to currencies on both sides of the divide?
Yeah, that's the real challenge here. I think, in Canada, we're sort of on the precipice. We've got a rate cut at the September meeting, largely discounted in the financial markets. In other words, markets are expecting that a cut will happen. Depends on the minute and the hour that you look at it, but around 75% odds on a move in September. Now the question is further out along the curve whether we'll see additional moves. And at the moment, it is just a single move that is priced in, but there is potential for a back-to-back cut, for example, if we continue to see inflation running at relatively stable levels and we continue to see the economy slowing more dramatically. Meanwhile, in the US, we are very clearly bracing for a more prolonged downturn in the economy, a more prolonged downturn in labor markets, and a Fed that can cut quite dramatically and quite aggressively from the levels that it's been at. And so, right now, across the next year and a half or so, we have six rate cuts priced in for the Fed. And so, the important thing for currencies and for equity markets in general is that the starting point is different, right? The Fed cut much later and cut less aggressively than the Bank of Canada. Rates in the US are clearly at much more restrictive levels than here in Canada. So there's more room to move, and so
I do want to add here as well. I think Karl here is 100% right. Canada started cutting rates more aggressively than the US did earlier. I think that's one of the criticisms that President Trump has had of the Fed recently. And it may be justified here is that they may be moving too slowly. Now, the Fed in the US was very focused on the inflation part of the balancing of the economy, and the tariffs weren't helping that, right? They were raising prices for US consumers as the tariffs were getting priced into consumers. So the Federal Reserve was seeing inflation climb. And now we're starting to see the other effects on the economy from the tariffs, which is reduced employment. And so, the balancing act that the Fed has is that they want to maintain, good, strong level employment levels, but they also want to tame inflation. And right now, those two things are working in opposite of each other. So I think what the risk here is that because Canada cut earlier, and we may have taken some pre some action earlier, when the US starts cutting their rates, it may start to um, diminish the US value of the US dollar even further. And that may actually cause the Canadian dollar to rally vis-a-vis the US. So that's something to be aware of. Of course, there's always the argument that if the U.S. sneezes, Canada catches a cold, and if the U.S. economy is going to take a downturn, that Canada's will as well. And so recently, our two currencies have actually been moving lower in conjunction with each other as opposed to opposite of each other. So that's something to keep in mind as we look at as we look at the dollar. I think also, and I don't know exactly when this was recorded, but I think the expectation now is almost a foregone conclusion that the US Fed will cut at least a quarter of a basis point. But one thing that's been happening over the last day or so is that there's more possibility or more probability being priced into a 50-point cut. Now, the Fed has been known to make drastic cuts in interest rates, particularly when there is a potential financial crisis in the offering. So, something to keep in mind is that the Fed can cut, and they can cut aggressively, and that would likely cause a rally in the Canadian dollar.
So, the possibility here is that when the Fed begins easing aggressively, and if it continues on that path, that will help to support global risk appetite, that'll help to support equity markets. They generally love to see, rates coming down. But I would also caution that, the risk here is that the Fed is cutting for a reason, that the economy really does slow dramatically, and that ultimately earnings expectations need to be revised down, and that indices need to climb down from the heights that they've been at.
There have been, I guess, some conversations. You probably know them better than we do.
One other comment here that I think is worth mentioning is the inflation hedge play that happens with commodities, right? So we talked about gold earlier and how gold is making new highs and stretching further as a safety asset. But I don't think we should overlook necessarily the rise in other commodities, particularly ag commodities, where we've seen some very big gains as the inflation story took hold and investors invested in commodities, even softs like lumber and cotton, but also ag commodities like corn and soybeans and wheat and things like that. So, any easing of inflation or any signs that there's going to be lower consumption, which means that the inflation hedge needs to be wound down, is a risk to our ag markets. However, I will say that we have seen a significant amount of change in the managed money or the speculative position sizing in some of these commodities. So, like soybean oil, for example, they are in a net long position, but they're only 13% of their record net long. Canola, same thing. There's been some significant reductions in the amount of canola longs recently. They're only now 14% of their record net long. We have some big short positions in the wheat markets. We have some big short positions in the corn markets. Minneapolis wheat actually is 72% of its record net short. So it's actually near the lower end of the largest short that we've seen in a while, which could signal that there's possibly some short covering that could come in there. But I don't want to be remiss and say that Karl here was talking about equity markets and how the lowering of interest rates could rally equity markets. It could actually do the opposite to to ag commodities if the market deems that the inflation story needs to be unwound. So I just wanted to point that out.
With respect to confidence in the US dollar, I guess starting to erode. Well, what are your thoughts on that?
Yeah, it's interesting because it's definitely something that's out there. There's definitely a perception among real money investors, especially institutional investors who invest for the long term, that there's a bigger risk premium in the U.S. dollar. In other words, there's more uncertainty about what the U.S. government will do over the future, over a long time horizon. There's more uncertainty around whether the U.S. government can continue to attract inflows from around the world from investors. And as a result, we've seen sort of a, how shall I put it, downgrading or a dilution in the dollar's exceptional status relative to other currencies. However, if we look at the actual data so far, it is not clear that investors are actually moving with their feet. That they're actually moving money out of the U.S. If anything, in recent months, inflows into the US economy have stabilized and have risen. And so, the thing to kind of think about here is that in the near term, there's a lot of noise, there's a lot of negativity around the US dollar. But in the long term, the real question is still, is there any other currency in the world that can supplant the dollar's role in attracting, the bulk of global equity capital and the bulk of debt funding from investors everywhere else?
Very true. When you look at the equity markets today, you'll realize that they're very close to recent highs. And normally, the equity markets are seen as a leading indicator, meaning that they will tell you ahead of the downturn in the economy by seeing losses ahead of time. Now, that can be somewhat offset by the fact that the equity markets are so heavily influenced right now by tech, by tech companies like the Googles and the Facebooks and the Teslas, even and things like that, and the AI push has been bringing a lot more dollars into the U.S. economy and into the stock market. One of the things that I've heard talked about recently is the K economy, where those who are asset rich, like they have financial assets or real estate assets, business assets. Those are the folks that are benefiting from the economy right now. If you ask them, the economy is going well, right? Their portfolios are expanding, the value of their homes is expanding. But on the other side of that is on the other side of the K, the downward point of the K is those folks that don't have assets, right? And those are the ones that are still, renting in this economy and they want to be, a homeowner. They're the ones who may have more consumer debt and, no assets to speak of. They have, low savings in their 401k, which would be the same as our RRSP here in Canada. So, there's the economy is kind of behaving in this, the rich are getting richer and the poor are getting poorer. And unfortunately, the, the jobs data that's coming out is more hurtful to that second category, the category of folks that are not asset rich. So it's kind of a double pronged thing that's happening right now. We aren't seeing the downturn in the stock markets ahead of an economic downturn, which is not normal.
Let's talk about that outlook then. You had mentioned a downturn in the US economy. Where do you expect the US dollar to end up, maybe by year end? And I guess on the heels of that, where do you think the loonie will go?
Right. So I have a real double-barreled forecast for you there. My belief is that in the near term, the dollar could climb. So the US dollar could actually climb just on the basis that the data coming out of the US economy is not likely to paint a very clear-cut picture in the near term. There are signs of re-acceleration in some areas of the US economy right now. Confidence coming up, manufacturing sentiment improving, things like that. That could mean that that some of those expectations for an aggressive easing trajectory from the Fed get pulled back a little bit. And so, if that plays out, the dollar could outperform the Canadian dollar through the end of this year. But then, over the next year and a half or so, I would expect that the combination of sort of isolationist policies from the administration, the lagging impact of, previous policy tightening, and that sort of overall erosion in the AI component of the economy could all mean that the U.S. economy slows and that other currencies get a chance to kind of move up against the dollar. So short term, the greenback could outperform against expectations, but over the longer run, I would expect it to fall and give the loonie some room to rally here.
All right. So there at the end there, he gave some predictions which are very interesting and could be contrary to some comments that I just made previous. So he's saying that there's opportunity for the Canadian dollar to continue to weaken against the U.S. dollar as in the short term, but in the longer term, they expect the U.S. dollar to fall, and that would give the opportunity for the Canadian dollar to rise. So that may mean here in Canada that we have some opportunity if the dollar is going to continue to fall. That would make some of our basis levels more attractive for the U.S. denominated commodities, which could raise our basis levels on things like wheat and soybeans and maybe even corn. This would be particularly helpful if we saw a reduction in the Canadian dollar and a rally or a post-harvest rally in the futures values, because that would just help kind of amplify or magnify the potential gains that we see in the commodity markets. So that's where it gives us some opportunity to maybe put in some target levels that are cash, which include futures and basis. It may give us some opportunity to put in target levels for just basis contracts, things like that. So just some things to think about here as we wrap up this currency assessment. Hopefully that was helpful for you. We thank you for joining us, and we will see you again